Hey everyone, welcome back to the channel. Today, we're diving into a super interesting topic, how to be an investment pro without a finance degree. For most of us, investing sounds like something only stock market wizards do, right? Well, today, I'm here to tell you that investing is actually closer to home than you think. And believe it or not, you don't have to be a wizard to make it work. We'll be learning from none other than Peter Lynch, the legendary American investor who has a special approach to help everyday people spot investment opportunities. Ready? Let's get started. All right, on to our first topic, how ordinary people can use their own knowledge to invest. Peter Lynch's philosophy is simple. He believes valuable investment opportunities are all around us, hidden in our everyday lives. Think that's a stretch? Let's hear what he has to say.
I think the reason I wrote it is I try to explain to people their great advantages, their edges they have, and that they should get involved in stocks.
Right.
And they should do it on the right basis.
This was on the first book.
Right.
Yeah.
And obviously I didn't make a great impression because the percent of people's assets involved in stocks has gone down. In 1960, people had 40% of their financial assets, including their house, in stocks and mutual funds. In 80, that was down to 25%. It's now down to 17%.
And why do you think that is?
Well, I think people, in the decade of the 80s was the best decade this century for stocks. I think people managed to lose money in the 80s doing it themselves because their methods were so flawed. So I really feel as though I wanted people to understand. I don't want anybody to buy a stock. I'm saying if you're going to buy a stock, you should do certain things.
Right.
If you're not willing to do these things, you should leave your money in the bank.
Your philosophy is simple, and I'm remembering this from the previous book. I think we're now talking about the previous book.
Correct.
Your philosophy was if you find something that you identify with. I remember there was a story of your wife and her hose.
Yeah.
Your wife kept saying,
legs
these
and
are
the panties. Oh, you got
legs,
it.
yeah,
Yeah.
the legs and panties. Your wife said, these are the greatest things I've ever seen.
Right.
And when your wife said that, you knew that this was a product that was better.
Right.
You used to stay at La Quinta Motel.
Right.
And the service was better, whatever was better.
Right. The
And
price was good,
And
too.
the price was good, too. And
Yeah.
you said, this is a place that I can determine. I, Peter Lynch, can tell that this is a good product, right?
That's right.
And if these people are making a good product,
That's
then their earnings are going to go up, therefore the stock's going to go up.
Right.
And that's the kind of decision-making process you ought to go through.
Right.
See? Peter's point is that if you're familiar with a certain industry, say you work in the restaurant business, you might be able to spot potential big winners before anyone else. Imagine a restaurant chain you know well is constantly expanding and drawing in big crowds. That's a sign. It's like being an undercover investment genius, able to see profit where others just see pasta. Instead of diving into industries you don't understand, like a chef running a hospital, just focus on what you know well and what you believe in. Our second point is about the relationship between profits and stock prices. Peter highlights a key factor here. Stock prices in the long run are driven by company earnings, not the everyday ups and downs of the stock market. Let's hear his take on it.
Exactly right. Well, I don't think people understand there's a 100% correlation with what happens to a company's earnings over several years and what happens to the stock. If the company, McDonald's has done very well as a company,
Right.
the stock has done very well. People worry about too much money supply, what's happened to the price of oil, whether, who's the president, who's being nominated for the Supreme Court,
It's all
the ozone
earnings.
layer. It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go
Yeah,
up.
but what they will say to you, Peter, is that, as you know, and why am I telling you this, but anyway, it's fun to tell you this, they're telling you that these other things influence the amount of earnings of a particular company.
Yeah.
If we're in a recession, people are not going to spend
That's
as
right.
much money on going to the movies
Absolutely.
or whatever they do.
Right.
And therefore, you got to pay attention to these other things because they impact on earnings.
They are very important, but you have no idea of knowing what they're going to do. Alan Greenspan's the head of the Federal Reserve.
Right.
He cannot predict interest rates.
Yes.
He'd be the first to
He
tell
can
you.
influence them, but he can't predict them.
He cannot predict what long-term interest rates are going to be 1 year from now, 2 years from now, 3 years. He's even surprised how low they are now.
Right.
So how am I supposed to predict interest rates? How am I supposed to predict the economy? You certainly remember the recession of '82.
Yes.
1982, we had a 20% prime rate, 14% unemployment, 12% inflation. I don't remember anybody telling me in 1980 or 81 that was going to happen. All of a sudden, we had the worst recession since the Depression. I didn't read about it in the paper. So it's crazy to think about.
Well, Peter gets straight to the point. Stock prices actually have little to do with all the random noise out there. As long as a company is profitable, its stock will likely go up. So don't let those "the market is crashing" or "oil prices are rising" headlines rattle you. As long as a business keeps turning a profit, it can withstand the market's short-term chaos. Think of it this way. If you know a bakery has the best pastries and people line up every morning, you'd probably want a piece of that pie, right? Focus on what really drives value: earnings. Now let's talk about Peter's stock picking methods. It's actually really simple. He believes in keeping an eye on brands you already know and trust. Peter says some of the best investments might just be in companies you're already a customer of. Let's see how he explains this.
Here's a quote from you. I own Dunkin' Donuts. When you own Dunkin' Donuts, you don't have to worry about Korean imports. You don't have to worry about M2 or M3. These are money supply figures,
Right.
aren't they?
Yep.
And what's happening to the money supply? This is the way you make money. If you don't understand what the company does, you should not be in it. If you could predict the stock market, you could predict the economy, you could predict interest rates. If you go buy the wrong stocks, you're going to lose half your money anyway.
Right.
Yeah.
I'm saying people have natural advantages.
Yeah.
Let's say what you do for a living is you're involved in the restaurant industry.
Right.
You supply paper products. You supply kitchen equipment. You help build restaurants.
Right.
You saw McDonald's. You saw Chi-Chi's. You saw Chili's. You saw Cracker Barrel. You saw Dunkin' Donuts, Kentucky Fried Chicken, Taco Bell.
These are all success stories.
These were 40-fold. You made 40 or 50 times your money. You don't need to make that kind of money many times in your life, right?
Yeah, no.
That's all you had to do was follow the restaurant industry.
Yeah.
People are in industries. They're in the publishing industry. They're in the chemical industry, the paper. Why don't they just stay with that industry? You only need a few stocks a decade. How many good stocks do you need in a lifetime? Instead of people that are in the restaurant industry, they're buying biotechnology stocks.
Right.
The people in the chemical
know
industry
nothing about
know nothing
biotech.
about it. The people in the chemical industry are buying oil stocks.
Right.
It's absolutely absurd. People don't understand their natural advantages, and they don't use them. So that's bad, number one. But worse, number two, is if you don't think you're a good ice skater, or if you're convinced you're not a good cellist, you're not going out and try it. But people are buying stocks anyway.
Yeah.
They're not discouraged. They just think it's a gamble.
Yeah.
So therefore, they go forward and they bet on one stock for a week and a half, and it goes up, and they make $2 on it. Then they sell it, and they buy something else. When 3 years is over, all they've done is generate a lot of commissions, and they've probably lost money. That's a mistake.
So your advice is what?
If you don't understand a company, if you can't explain it to a 10-year-old in 2 minutes or less,
Yes.
don't own it. Because when it goes down, let's say the stock goes down 2 points.
You won't understand what's going on.
What do you do? Do you buy more? Do you flip a coin?
And chances are your broker doesn't either?
He or she certainly doesn't know about it. I mean, who knows what all these things are with auto back planes and mega flops? Who knows what all these
So buy what you know.
Buy in your industry, buy what you know, buy local companies.
Yeah, so suppose you don't have an industry. I mean, you don't really...
You buy local companies, companies in your own industry. 10 years after Walmart went public, 10 years after it went public. 10 years after it went public. It's a 25-year-old company now.
Right.
You could have bought the stock and made 50 times your money on it. 50 times.
If you bought it 10 years
after it was public already.
Yeah.
It had already gone up fivefold. So you could have made...
Wait, making money off of fried chicken? That sounds like a win-win. Imagine this. You go to a restaurant, the food's great, the prices are reasonable, and it's always packed. That's a good signal that the business has something special going on. Think about the brands or products you use daily and really like. They might just be worth investing in. And unlike those confusing companies in sectors you don't understand, these familiar ones feel more approachable, right? Next up, Peter offers some practical tips to avoid common investing mistakes. He doesn't just tell us which stocks to buy, but also how to stay out of trouble. Let's hear his advice.
But I'm saying, let's say you were in a town, they came into it and they said, boy, these prices are great, they're doing terrific, I like the bargains, and you checked it out. You spent a little bit of work on it.
Yeah.
I mean, people are very careful. When they buy a dishwasher, they do some research. They'll put $10,000 in some stock they hear on a bus. So if you did a little bit of research, you'd say, Walmart's only 10% of the country, they're not even saturated there. Why can't they go to the rest of the country?
So is this is more of the same? Is it what it is?
It's more of the same, plus I show examples. It's a touch more detailed. It actually shows me in action.
Right.
I picked 21 stocks early in 1992. Some work, some don't. I follow those companies. Some of the companies, the fundamentals deteriorate. Some they improve. I watch those companies go through the year. I also explain the retail industry. I try and make it very simple. And I talk about a wonderful example. Is a 7th grade class.
Yeah.
The teacher of that read my book, and my first book that you were talking about. You and I did a show on that in Washington.
Right.
You remember that show?
Right.
This is
Right.
a long time ago. She read the book, and I said, if you made it through 5th grade math, you can do it in the stock market. She says, okay. She started teaching it in 7th grade, 7th grade class. These kids had to study companies. They had to look at their balance sheets to see if they're solvent.
Yeah.
And they picked stocks. These stocks were up 69% over 2 years when the market was up only 20. And they picked stocks like Limited, they picked the Gap, they
Right.
picked Walt, they understood these companies. They also picked IBM. I lost money on that too. I mean, everybody makes mistakes.
Everybody did, yeah.
But I'm saying this was a school, St. Agnes' School in Arlington, Mass.
Right.
But in addition, in the decade of the 80s, there's 8,000 investment clubs. These are amateur, sort of
Right.
average people just investing. These investment clubs, 62% of them, of these clubs, beat the market. In the decade of the 80s, only 25% of professionals beat.
Peter's advice is spot on. He says that if you don't understand what a company does, don't invest in it. Imagine putting your money into a company and then the stock drops. You'd be totally confused, right? This is why he emphasizes buy what you know. It's safer and much easier to hold on to stocks when you truly understand how the company makes money. If you invest in things you understand, you'll feel much more confident and less like you're playing a risky game of chance. All right, let's wrap up today's session with a summary of Peter Lynch's 4 key points. Here's what we covered. Number 1, use your familiarity. Invest in industries and companies you know well. If you're in the restaurant business, maybe you're in the best position to spot good restaurant stocks. Number 2, focus on profits, not short-term noise. A company's long-term growth depends on its earnings, so don't worry too much about the daily market swings. Number 3, observe and analyze. Keep an eye on popular brands, products, or businesses around you and use these as starting points. Number 4, avoid the hype. If you don't understand a company, don't invest in it. Stick to what you know to avoid unnecessary risks. For example, let's say there's a popular coffee shop in your neighborhood that's always busy every morning. This could be a hidden investment gem, just like Peter's philosophy suggests. Or maybe you're a fan of a particular smartphone brand because of its quality and everyone around you uses it. That's another great sign. All right, that's all for today. If you enjoyed Peter Lynch's everyday investor wisdom, don't forget to like and subscribe. Your support means the world to us. I hope you all feel inspired to invest smarter and enjoy the process. See you next time, and happy investing.